Listen to me very carefully because what I'm about to tell you could save your family hundreds of thousands of dollars or cost them everything if you get it wrong. I'm Kevin O'Leary and I've been building wealth, protecting wealth, and passing on wealth for over 40 years. I've helped hundreds of families navigate estate planning. I've seen people do it right, and I've seen people absolutely destroy their family's financial future with one stupid mistake. And today I'm going to tell you the single biggest tax mistake people make when trying to pass their home to their kids. Now, before I tell you exactly what this mistake is and how to avoid it, I need you to do something for me right now. Hit that subscribe button. Smash it because this channel is about protecting your money, protecting your family, and making sure you don't get screwed by taxes you don't have to pay. I don't sugarcoat things, and I expect you to take action. So subscribe, turn on notifications, and let's make sure your family doesn't lose a fortune to the IRS. Here's what's happening right now in America. Millions of baby boomers own homes that have appreciated massively over the past 30, 40, even 50 years. You bought your house for $80,000 in 1985. Today it's worth $600,000, maybe $800,000, maybe more. That's fantastic. You've built real wealth. You've done everything right. You bought when prices were reasonable, you paid down your mortgage, you maintained your property, and now you're sitting on a gold mine. But here's the problem. Most of you have no idea how to pass that wealth to your kids without the government taking a massive bite out of it. And I mean massive. I see this all the time. Good, hard-working people who did everything right. They bought a house, paid off the mortgage, raised their family, lived the American dream, and now they want to give that house to their kids. Sounds simple, right? It should be simple. You worked for it, you paid for it, you own it. You should be able to give it to your kids without the IRS standing there with their hand out. But that's not how it works. This is where people make catastrophic mistakes that cost their children tens of thousands, sometimes hundreds of thousands of dollars in completely avoidable taxes. And the worst part, they don't even know they made the mistake until it's too late to fix it. Your house is probably your single largest asset. For most Americans, their home represents 50, 60, maybe 70% of their total net worth. Think about that for a second. 70% of everything you've built, everything you've worked for, is tied up in that one asset. So when you screw up the transfer of that asset, you're not making a small mistake. You're making a mistake that could wipe out a huge chunk of your family's inheritance. That's unacceptable. And I'm not going to let that happen to you. Now, I know what some of you are thinking. Kevin, I'll just put my kids' names on the deed now while I'm alive. Problem solved. I'll add them as co-owners, and when I die, the house automatically goes to them. No lawyers, no probate, no hassle. No, stop right there. That is exactly the mistake I'm talking about. That is the worst thing you can do. And I'm going to explain exactly why in excruciating detail so you never even think about doing it. But first, if you're realizing that maybe you don't know as much about estate planning as you thought, if you're starting to understand that this is more complicated than you realized, do me a favor. Hit that like button right now. It helps this video reach more people who need to hear this message. And drop a comment below. Tell me, do you own a home? Are you planning to pass it to your kids? Have you already added them to the deed? Let me know. I read the comments and I want to hear from you because your situation might help someone else avoid a disaster. All right, let's get into the biggest mistake people make. The mistake that costs families more money than almost anything else in estate planning. The mistake is this: adding your children to the deed of your house while you're still alive. People do this all the time. I mean all the time. It's probably the most common estate planning mistake in America. They think they're being smart. They think they're avoiding probate. They think they're making things easier for their kids. They think they're getting ahead of the system. But what they're actually doing is setting their children up for a tax nightmare that could cost them $100,000 or more. Here's why this is such a disaster. When you add your kids to the deed while you're alive, you're making a gift. And when you make a gift of property, the recipient gets what's called your cost basis. Let me explain what that means, because this is absolutely critical. This is the foundation of everything else I'm going to tell you. Cost basis is what you originally paid for the property, plus any improvements you made over the years. Let's say you bought your house in 1980 for $100,000. Over the years, you put in a new kitchen for $30,000, added a bathroom for $20,000, replaced the roof for $15,000, and finished the basement for $25,000. Your total cost basis is $190,000. But today, after 40 years of appreciation, your house is worth $750,000. Now, here's where it gets ugly. If you add your kids to the deed now and gift them the house while you're alive, they inherit your cost basis of $190,000. Not the current value of $750,000, your basis, the basis from 40 years ago. Now, let's say you pass away a few years later and your kids decide to sell the house. Maybe they don't want to live in it. Maybe they live in different states. Maybe they need the cash. Whatever the reason, they sell it for $750,000. Guess what happens next? They have to pay capital gains tax on the difference between the sale price and the cost basis. That's $750,000 minus $190,000, which equals $560,000 in capital gains. Let me tell you what that means in real dollars. At the current long-term capital gains rate, which is 15% for most people, but can be 20% if your kids are high earners, we're talking about $84,000 to $112,000 in federal taxes alone. And if you live in a state with income tax, add another 5, 8, maybe 13% if you're in California. In California, your kids could be paying close to $185,000 in total taxes on a house you already owned, on wealth you already created. Just because you made one mistake trying to be helpful, let me say that again so it really sinks in. If you gift your house to your kids while you're alive, they could pay close to $200,000 in taxes when they sell it. Does that sound like a good plan to you? Does that sound like you're helping your kids? Because you're not. You're destroying their inheritance. You're handing over a massive chunk of their money to the government for absolutely no reason. Now, here's what makes me furious about this whole situation. People do this because someone told them it avoids probate. A neighbor, a friend, maybe even a financial advisor who doesn't know what they're talking about told them, just add your kids to the deed. It'll avoid probate. And yes, technically it does avoid probate. You know what probate is? It's a legal process where the court supervises the distribution of your estate. It takes some time, it requires some paperwork, and it costs some money. How much? In most states, maybe $3,000 to $5,000 for a typical estate. Maybe it takes 6 months to a year. So let me get this straight. You're so worried about probate, which costs maybe $5,000 and takes a few months, that you're willing to cost your kids $150,000 or $200,000 in taxes? That's insane. That's like being so afraid of getting a parking ticket that you total your car to avoid the parking meter. The cure is 100 times worse than the disease. Here's the other problem with adding your kids to the deed while you're alive, and this is something most people never even think about. You're creating all kinds of other risks that have nothing to do with taxes. If your kid gets sued for any reason, a car accident, a business dispute, anything, guess what? That house is now part of their assets. It can be seized to satisfy a judgment. You just took your safe, protected, paid off asset and exposed it to your kid's legal liabilities. If your kid goes through a divorce, and statistically about half of marriages end in divorce, guess what happens? In most states, that house is now part of the marital estate. It can be split with their ex-spouse. Your son or daughter's ex could end up owning half of your house, the house you worked 30 years to pay off, the house you raised your family in. Half of it could go to someone you can't stand, who's no longer even part of your family. Is that what you want? If your kid has creditor problems, files for bankruptcy, gets into financial trouble, makes bad business decisions, that house is exposed. It's fair game for creditors. You just took the most valuable asset you own and threw it into the shark tank of your kid's financial life. Every risk they have, every liability they have, now threatens your house. Brilliant move. Not. And let me tell you something else that nobody talks about. Once you put your kid's name on that deed, you can't just take it off if you change your mind. You need their permission. They have to agree to sign the property back to you. What if you have a falling out? What if your relationship deteriorates? What if they make decisions you don't agree with and you want to change your estate plan? Too bad. You gave up control. You're stuck. What if you have to sell the house to pay for your own long-term care? Nursing homes cost $8,000, $10,000, $12,000 a month. What if you need that money and your kid won't agree to sell? What if your kids are fighting among themselves about whether to sell or keep the property and they can't agree? You just gave up control of your biggest asset. At 70, 75, 80 years old, you're now at the mercy of your children and their spouses and their financial situations. Is that really the position you want to be in? I sure wouldn't want to be in that position. I've seen this destroy families. I've seen it in my own circle of friends and business associates. Parents who thought they were doing the right thing, being proactive, helping their kids, and then they need to sell the house for medical expenses or to move into assisted living, and suddenly the kids won't sign off. Or one kid wants to sell and the other wants to keep it and they're in a deadlock. Or the kid's spouse is pressuring them not to sell because they want to inherit it. It's a nightmare, a complete nightmare. And it was all preventable. So if gifting the house while you're alive is the wrong move, and believe me, it is absolutely the wrong move, what's the right move? I'm going to tell you. But first, let me explain the magic of something called the step up in basis. This is the key to everything. This is the secret weapon that saves your family a fortune in taxes. This is what separates smart estate planning from dumb estate planning. Pay attention, because this is the most important part of this entire video. When you die and leave your house to your kids through your will or a trust, your kids get what's called a step up in basis. That means the cost basis of the house is adjusted, stepped up, to the fair market value on the date of your death. Not what you paid for it 30 or 40 years ago. Not your old basis. The current market value. Let me give you the same example as before so you can see the massive difference. You bought your house for $100,000. You put in $90,000 in improvements over the years. So your total basis is $190,000. The house is now worth $750,000. You die and leave the house to your kids through your estate, either through a will or through a trust. On the date of your death, the house is appraised at $750,000. That becomes your kid's new basis, $750,000, not $190,000. $750,000. Now, if they turn around and sell the house 6 months later for $750,000, guess how much capital gains tax they pay? Zero. Nothing. Not a single penny. Because there's no gain. The basis is $750,000 and the sale price is $750,000. No gain equals no tax. Even if they wait a year and the house appreciates to $780,000 and they sell it for that, they only pay tax on $30,000 in gains. That's maybe $4,500 to $6,000 in taxes instead of $150,000 or $200,000. Do you see the difference now? Do you see why the step up in basis is the most powerful estate planning tool you have? Do you understand why every estate planning attorney in America will tell you not to gift your house while you're alive? By doing nothing, by simply holding on to the house until you die and passing it through your estate, you save your family potentially hundreds of thousands of dollars. You don't have to be a genius to understand this. You don't have to have a law degree. You just have to not screw it up. This is what I mean when I say that in estate planning, sometimes the best move is to do nothing. Don't try to be clever. Don't try to outsmart the system. The system has already given you an incredible benefit. The step up in basis is a gift from the tax code. It's legal. It's built into the law. All you have to do is not mess it up by gifting your assets before you die. Now, I can already hear some of you saying, but Kevin, I don't want my estate to go through probate. Probate is expensive and takes forever. I heard horror stories about probate. Okay, I hear you. Probate can be a hassle. In some states, it's worse than others. In California, for example, probate can take a year or more and the fees are based on a percentage of the estate value. In other states, it's quicker and cheaper. But here's the thing. Even in the worst case scenario, probate is still way cheaper than losing the step up in basis. Way cheaper. But you know what? You don't even have to choose. You can avoid probate and keep the step up in basis. How? You put your house in a revocable living trust. This is the solution. This is how you get the best of both worlds. You avoid probate and you preserve the step up in basis. This is what smart people do. This is what I do with my own assets. This is what every wealthy person in America does. A revocable living trust is simple. You create a legal document, the trust agreement. You name yourself as the trustee, which means you control it. You transfer your house into the trust by signing a new deed. And you name your kids as the beneficiaries who will inherit the trust assets when you die. That's it. Simple. During your lifetime, nothing changes. You still control everything. You can still sell the house if you want. You can refinance it. You can take out a home equity line. You can do whatever you want because you're the trustee. You're in control. But when you die, here's what happens. The trust owns the house, not your estate. So it doesn't go through probate. There's no court process. There's no waiting. There's no probate fees. The house passes directly to your kids according to the terms of the trust. It's quick, it's private, and it's clean. And here's the beautiful part, the part that saves your family a fortune. The house is still included in your taxable estate for estate tax purposes, which means your kids still get the step up in basis. The IRS treats it as if you owned it when you died, which you did through the trust, so your kids get a stepped up basis to the fair market value at your death. You avoid probate and you avoid the tax nightmare. Perfect. This is exactly what you want. Setting up a revocable living trust costs money. I'm not going to lie to you. Depending on where you live and how complicated your situation is, you're looking at $1,500 to $3,000 for a good estate planning attorney to draft the trust and help you transfer your assets into it. Maybe more in expensive cities. But think about what you're getting. You're avoiding probate, which could cost $3,000 to $5,000 or more. And you're preserving the step up in basis, which could save your kids $100,000 to $200,000 in taxes. So you spend $2,000 to save potentially $200,000. Show me another investment with that kind of return. Show me where else you can turn $2,000 into $200,000 of value for your family. You can't because it doesn't exist. This is the no-brainer of all no-brainers. Every single homeowner who wants to pass their house to their kids should have a revocable living trust. Period. End of story. If you don't have one, you're making a mistake. And the longer you wait, the more likely it is that something happens and it's too late to fix it. Now, let me address another mistake people make, and this one is just as bad. Some people think they can avoid all of this by just adding one kid to the deed as a joint tenant with right of survivorship. They figure when they die, the house automatically goes to that one kid, no probate, no problem, and then that kid can distribute shares or proceeds to the other siblings. It sounds reasonable, right? Wrong. Wrong on multiple levels. First, same problem as before. No step up in basis for the portion you gifted. If you add one kid as a 50% owner, they get your basis on their 50%. When they sell, they pay capital gains on their share. Second, you've now created a family fight waiting to happen. One kid owns the whole house after you die, and the others have to trust that kid to be fair and share it properly. What if that kid decides they deserve more because they were on the deed? What if their spouse pressures them to keep it all? What if there's already tension in the family? You just lit a stick of dynamite in the middle of your family relationships. I've seen siblings who were close their entire lives stop speaking to each other over this exact situation. One sibling is on the deed, the others aren't. And after the parents die, the one who's on the deed acts like they own it all. Mom and Dad gave it to me. My name is on the deed. Too bad for you guys. And the other siblings feel cheated and betrayed, and the family is destroyed. All because the parents thought they were being clever by avoiding probate. Here's what you need to understand, and I'm going to say this in the simplest possible terms. The IRS gives you this incredible gift, the step up in basis, if you just leave your assets in your estate when you die. But you have to actually die owning the assets, either directly or through a revocable trust. If you give them away before you die, whether it's adding kids to the deed or making an outright gift or any other clever scheme, you lose the step up. It's that simple. The rule is straightforward. Die owning it. Get the step up. Give it away before you die, lose the step up. So the strategy is obvious. Hold on to your assets, put them in a revocable trust to avoid probate, name your kids as beneficiaries of the trust, and let your heirs get the step up when you die. This is estate planning 101. This is the foundation of everything. And yet, people screw it up every single day because they listen to their neighbor or their brother-in-law or some article they read online instead of talking to a qualified estate planning attorney. Let me give you some real numbers from actual markets so you can see how much this matters in the real world. According to the latest data, the median home value in America is around $350,000 to $400,000. But in many markets, especially high-cost areas, we're talking about houses worth way more than that. In California, the median home price in the Bay Area is over $1 million. In some neighborhoods, it's $2 million or more. In New York, in parts of the suburbs, homes are $800,000, $1 million, $200,000. In Seattle, in Denver, in Austin, in Miami, homes have appreciated like crazy over the past decade. Let's say you're in the San Francisco Bay Area. You bought your house in Palo Alto or San Jose in 1985 for $200,000. At the time, that was a lot of money. You stretched to afford it. You had a big mortgage, but you made it work. Today, that same house is worth $2,200,000. The appreciation has been insane. If you gift that house to your kids while you're alive, they have a basis of maybe $250,000 including improvements. When they sell it for $2,200,000, they have a $1,950,000 capital gain. Let me tell you what that costs in taxes. Federal capital gains tax at 20% is $390,000. California state tax at 13.3% is another $259,000. Total tax bill, $649,000. $649,000 gone because you made one mistake. But if you leave the house in your estate or in your revocable trust, your kids get a step up to $2,200,000. They sell it for $2,200,000. Zero capital gains, zero taxes. They save $649,000. Do you understand what I'm saying? We're not talking about saving a few $1,000s. We're talking about over $500,000. That's generational wealth. That's money that could pay for your grandkids' college education. That's money that could be a down payment on a house for each of your children. That's money that could change your family's financial future. And you're going to throw it away because you didn't want to spend $2,000 on a trust? That's insane. Now, some of you might be thinking about the estate tax. You're worried that if your estate is too big, you'll get hit with federal estate taxes. Let me put your mind at ease right now. The federal estate tax exemption in 2024 is $13,610,000 per person. Let me repeat that. $13,610,000. If you're married, you and your spouse together have $27,220,000 in combined exemption. That means if your total estate, including your house, your retirement accounts, your bank accounts, your investments, everything you own is under that amount, you pay zero federal estate tax. Not a penny. For the vast majority of people watching this video, estate taxes are not an issue. You're not going to pay them. Even if you have $1 million house and $500,000 in retirement accounts and some savings, you're nowhere near the exemption. So don't let fear of estate taxes push you into making the gifting mistake. It's not a concern for most people. Now, if you do have an estate over $13 million, first of all, congratulations. You've done extremely well. But second, you need to be working with a high-level estate planning attorney who specializes in large estates. You have much more sophisticated strategies available to you. Irrevocable trusts, grantor retained annuity trusts, charitable remainder trusts, family limited partnerships, all kinds of advanced planning tools. But for 95% to 98% of the people watching this video, the simple answer is hold the house, use a revocable trust, get the step up in basis, and save your kids a fortune. Let me talk about timing for a second because this is really important. If you've already made the mistake, if you've already added your kids to the deed, you need to fix this as soon as possible. You can deed the property back to yourself. Your kids can execute a quitclaim deed transferring their interest back to you. Then you can set up a revocable trust and transfer the house into the trust properly. Yes, there might be some costs involved. You might need an attorney to help you. It might cost you $500 or $1,000 or even $1,500. But that's a tiny price to pay to preserve a potential $100,000 or $200,000 tax benefit for your kids. Do it today. Don't wait. Don't procrastinate. Every day that goes by is another day you're at risk. Most people procrastinate, or they think they'll get to it eventually, or they convince themselves it doesn't matter. And then they die, and their kids get stuck with a massive tax bill that was completely avoidable. Don't be that person. Be the person who plans ahead. Be the person who protects their family. Be the person who takes 2 hours and spends $2,000 to save their kids $200,000. That's the smart move. That's what winners do. Now let me be very clear about the action steps because I want you to walk away from this video knowing exactly what to do. Step 1, do not, I repeat, do not add your kids' names to your deed while you're alive. If you've already done this, talk to an attorney immediately about reversing it. This is priority number 1. Step 2, find a qualified estate planning attorney in your state. Not just any attorney, an estate planning specialist. Ask friends for referrals. Check online reviews. Make sure they focus on trusts and estates, not divorce or criminal law or personal injury. You want someone who does this every day. Step 3, schedule a consultation and set up a revocable living trust. The attorney will ask you about your assets, your family situation, your goals. They'll draft the trust documents. You'll review them, sign them, and get them notarized. The whole process usually takes a few weeks. Step 4, and this is critical, make sure your trust is properly funded. This means actually transferring your house and other major assets into the trust's name. A lot of people create a trust and then forget this step. They think having the trust document is enough. It's not. You need to sign a new deed transferring your house from your personal name to the trust. Your attorney should help you with this. Step 5, review and update your trust every few years, especially if your family situation changes. If you have more kids or grandkids, if someone dies, if you move to a different state, if tax laws change, you might need to update your trust. It's not a one and done thing. It's a living document that should reflect your current situation. That's it. 5 steps. You can get this done in 30 to 45 days. And once it's done, you can sleep easy knowing your family is protected and you're not going to cost them a fortune in unnecessary taxes. I've been doing this for over 40 years. I've structured deals worth billions of dollars. I've protected assets in every way imaginable. I've seen every estate planning mistake you can make. And I can tell you with absolute certainty that this strategy works. It's not complicated. It's not risky. It's just smart, basic estate planning that every homeowner should have. Your house is probably the biggest thing you'll ever own. Protect it. Protect your family. Do it right. So here's my final challenge to you. If this makes sense, if you're ready to protect your family's wealth and stop making expensive mistakes, I need you to do 3 things right now. First, hit that subscribe button and become a member of this channel. We're building a community of people who want to protect their money and build generational wealth. No BS, no gimmicks, just the truth. Second, smash that like button so more people can see this video and avoid this catastrophic mistake. And third, leave a comment below. Tell me, do you have your house in a trust? Are you going to set one up after watching this? Have you already made the mistake of adding your kids to the deed? Let me know. I read every comment and I want to hear from you. Remember, you've worked your whole life to build wealth. Don't throw it away with one preventable mistake. Set up a revocable living trust, preserve the step-up in basis, and save your family hundreds of thousands of dollars in taxes. That's it. That's the secret. Don't gift your house while you're alive. Put it in a trust. Let your kids inherit it with a step-up in basis. Simple, smart, and it could save your family a fortune. Now, go make it happen.